Hello, everybody. Ed Yardeni here. It's October 20th. It's Monday. And man, are we having fun or what? It's been a bit of a roller coaster ride this year, but all in all, it's been what I describe as a joyride since the pandemic. We had that sell-off for a couple of months there in March, and well, actually, it wasn't even that. It was kind of February, March. March 23rd, we made a low, and it's been basically up, up, and away with a few corrections, one bear market. All in all, not too bad an experience. But of course, it's been emotional, it's been volatile, and lots to still worry about. After all, it is almost Halloween, and Halloween is a time when we're supposed to get spooked, or at least it should be trick or treats, and hopefully it'll be treats rather than tricks. But the focus of the past few weeks among the bears, the pessimists, the naysayers, has been that the market's very concentrated. That's been an old story. That valuation multiples are very high. Maybe they're too high. That's an old story as well. Maybe we're about to have a credit crunch because there's some problems in the subprime auto market, some problems in the auto parts market. Maybe this is just as Jamie Dimon said, famously said, I guess this will be immortal. Maybe it'll be on his tombstone. There's never just one cockroach. When you see one, there's probably more. There usually are more, but it doesn't have to necessarily be an infestation. And then, if you live in a New York City apartment, you can always get a tape to seal your any cracks in your apartment and try to keep them out. But I guess they can come in through the kitchen sink. Anyways, let's not talk about that anymore. Cockroaches are no fun. They're certainly disturbing when you see them. But even so, despite the cockroach statement, the markets is doing quite well. We had that sell-off on Thursday of last week on the credit concerns issue. But here we are with the market up substantially this morning. It's actually been a pretty good morning for just about every major asset class. Gold is up, let's see, it's up a lot. It's up 134, all-time record high. We were shooting for 4,000 by the end of this year. Never mind, we're past that. So now we're shooting for 5,000 by the end of next year or by the end of this year. I mean, things move awfully fast here, so it could be higher. I've been arguing that gold is the new Bitcoin. If you think about it, gold and Bitcoin do have a lot in common. They're both traded globally on a 24/7 basis. This is not the kind of the tulip bubble issue. Remember, remember? I don't even remember, and I've been around for a while. But from your history books, you'll remember the tulip bubble mania in Holland, particularly in Amsterdam. And Amsterdam was a really pretty tiny town. Once everybody had bought their tulips, there wasn't any more buyers or the sucker of last resort to keep the price up. And so the price collapsed. But that market was tiny, and it certainly wasn't global. And people went to sleep at night. With gold and Bitcoin, you can watch gold trade all night. I think you can watch Bitcoin trade all night as well. I've been really watching gold more than I have been Bitcoin. But Bitcoin's doing well. It was doing rather poorly. But I think the difference between Bitcoin and gold is gold is physical Bitcoin. In other words, you're pretty well assured that there's a bar there sitting there somewhere to back up your position in the market. I think the same thing is true with Bitcoin, but there's always that hacking issue hanging over that marketplace, the possibility that somebody will come up with a program that unlocks the key. And so you'll be looking for your $2 million Bitcoin deposit, and suddenly it's gone. And so who do you call? Do you call the local police department? Do you call the FBI? Well, what are you going to do? So I think that's kind of one difference. The other thing is, at least until today, it seemed like Bitcoin was trading more as a risk-on asset. Well, I guess today it is sort of risk-on day, so it is trading as a risk-on asset. But at the same time, we still have the risk-off asset, which I think is gold, doing very well. So look, this Middle East ceasefire looks like it's, they haven't ceased firing at each other over in that part of the world. Uh, Trump and Zelensky had a rather heated exchange about whether Ukraine should give up the Donbass to Russia, and so that's obviously heating up the geopolitical situation. And now, by the way, we got the rare earth metals dispute with the Chinese. We got a trade war basically with the Chinese. I think November 1st, which is only a few days away. Trump said he was going to slap 100% additional tariff on the Chinese, but he could change his mind before that. Obviously, he's done that before. But there's certainly an argument for both risk on and risk off at the same time, and those arguments seem to be playing out fairly well right now. With regards to the stock market, I've had the opinion that I tend to be a little bit of a contrarian. I don't do it on purpose. I don't do it just to be a contrarian. I like to have the fundamentals behind me. But I've been arguing that maybe we have nothing to fear, but all the fear about bubbles. Everybody's talking about it. I was around in the late 1990s. Some of you might have been around as well. And I don't recall, and you can send me emails or give me a call, correct me if I'm wrong, but I don't recall as many people talking about a bubble in dot-coms and a lot of concerns that was going to burst, which is exactly what it did. This time around, everybody's twitchy about things bursting. Look, with regards to AI, compared to the 1999 situation, in 1999, there were a lot of telecommunications companies that borrowed in the junk bond market to sell or finance their merchandise to dot-coms. The dot-coms got one round of financing. They didn't get the second round because investors figured out that there was nothing really there. And so the dot-coms blew up and couldn't pay back the sellers that provided seller financing. And so it all kind of imploded pretty in a big way. The internet survived, but we had a lot of empty, dark fiber, as they called it. We put a lot of glass fiber cables around, and they weren't used all that much. But the internet survived, and it's obviously made a huge difference in our personal and professional lives, our business lives. Well, in the current situation, yeah, maybe they're spending too much on data centers. Maybe. If they are, a lot of it seems to be financed with cash flow. Only a couple of years ago, everybody was very excited about the Magnificent Seven because they generated a lot of cash flow. They didn't have any debt. The tightening of monetary policy didn't have much influence on them. And they actually benefited a lot from the consequences of the pandemic. And so they were truly magnificent. And now people were wondering whether they're still magnificent now that they're spending a lot of their cash flow on data centers. Look, if they are, then they'll figure it out, and they'll dial back their spending, and they'll show even more profits. So I'm not all that concerned that we've got an AI bubble here. I do have my issues with AI. It does still tend to produce errors. It does still tend to be less than a genius kind of program. It does still hallucinate, I suppose. But then again, I'm using it every single day as a research assistant. And it's kind of like when you hire a research assistant, they have a great resume and you figure you can trust them. And well, you don't really know until you actually hire them and see how they're doing. And if they're relatively young, they're probably not very well experienced. There was an article in the Wall Street Journal that said that the demand for workers who have experience actually goes up with AI because somebody's got to edit the AI. Somebody's got to double check that AI isn't making mistakes. And young folks without much experience aren't going to be in the position to do that. I mean, it does kind of raise the question, well, what happens when all these experienced people retire and we haven't had any entry-level positions to train younger folks? Well, we'll deal with that along the way here. But right now, I think all in all, the market is telling us that the AI spending is legit and it's sustainable and it is going to be profitable and that there's a demand for it. I mean, who's in a position to know more about the capacity of data centers than the hyperscalers? They're watching it every single day. They got the dials right in front of them, and they can tell it, how quickly the demand for the cloud computing, which has obviously been tremendously boosted by all this AI. Well, so anyways, that's my happy spin on things. Also this morning, I gave you a happy spin on issues that have been hanging over our head for a long time. The debt crisis, I pointed out that's been an issue that I've been dealing with since the 1980s. I've got some books on the bookshelf there, Living Beyond Our Means, the debt crisis, the coming debt crisis. A lot of books written in the 80s. I guess the latest one in that genre is Ray Dalio's book on how countries go broke. And he's obviously been quite an alarmist about the debt crisis. And so far, maybe he's right about the UK, certainly Japan, France, though we did see those bond yields over there actually came down the past week on credit quality concerns. When there's credit quality concerns, even a French government bond looks pretty good compared to what might be occurring in the credit markets. But with regards to the credit markets, we'll see how things play out, obviously. But my impression is that when things blow up, particularly in the private equity market, it's a haircut to somebody's rate of return. It's not a reduction in the capital, which forces the financial institution to reduce lending, thus producing a credit crunch. Now, clearly, first, Zion is a bank, and so maybe that's the beginning of a regional problem. But look, if there is a regional problem, those stock prices are going to go down, and the big banks are going to see tremendous opportunities to acquire some of those companies. Some of them may simply consolidate, may merge. So I'm not particularly worried about that. The capital markets has been one of the sources of America's exceptionalism. I guess it may be stress tested here, but I think it'll pass the stress. And besides, everybody has figured out that the Fed is back in the put business. The Fed put is back. It actually came back last year, right? The Fed cut the Fed funds rate by 100 basis points. I thought that was not a good idea. I thought the bond yield might go up. It went up more than I thought. It went up 100 basis points. This time around, the Fed cut by 25 basis points. That got us down to 4%. Now we're kind of hanging on by our fingernails here. Let me see where we are. Let's make this real time. Yeah, wouldn't you know, we're at 4.000% as we speak. So this market's about to go one way or the other. I guess you could put out some sort of straddle spread and make a lot of money because it's the yields are either going to go up a lot or down a lot. I'm thinking that the FOMC's meeting October 29th, and there's my contrarian instincts coming along. October 24th, the CPI was delayed to just a few days before the FOMC. Wouldn't it be kind of interesting if it turns out that the CPI comes in hotter than expected? Now, the administration has said that their tariffs have not increased the inflation rate at all, because it hasn't increased. It's been kind of at 3% for the past several months. But my point is it would have probably been down to 2% if it hadn't been to tariffs. And the fact of the matter is, there's no denying that durable goods inflation in the CPI and in the consumption deflator has increased from something like -4% to something like +1%. I had dinner with some friends last night, my wife and I and two other couples, and one of the guys owns a medical supply company, small medical supply company, and another one works for, believe it or not, a bean company. And he said the cost of steel is affecting the cost of tin, and they're now starting to raise their prices. The medical supply guy told me that they used to import a lot of stuff and distribute it from the United States. Now they're distributing it from where they get it overseas directly to who needs it, and that's affected their need for uh, employees in the warehouses. So these tariffs have really haven't played out completely, and I think on the inflation side they may still surprise us to to the upside. Well, let's have a look at some charts. I think it's always good to see what the data shows. And today I'm going to start you off with the quick takes. I got a lot of good feedback on the quick takes. We've been doing them now for almost, well, over 2 years, maybe 3 years for all I know. But I appreciate the positive reviews on it. And at least it's a quick read, and yeah, usually it comes late at night because that's when I write them. But take a look at this. This is the S&P 500, the 10-year average, year-to-date percent change. So you can see that on average over the past 10 years, we've averaged a little over 12%, which is pretty good. And that doesn't include dividends. So that would, including dividends, would be even better. This is the same year-to-date percent change so far this year, and it's been a much more volatile year. We had the Liberation Day sell-off here, and so things have been pretty volatile. And then we kind of came back to the norm of being up about, I guess, 8% or so. And then starting in, I guess this looks like early August, we've seen this thing continue to move higher. So could it be this the Santa Claus rally has already happened, and the rest of the year is kind of flat to down? It could be. This is the traditional Santa Claus rally. We go from about 8% to 12% from early November through December. So that's 4 percentage points added to the performance. Not too bad, 8%. And then in a couple of months, we get an extra 4% from Santa. I think we could still do 3 to 4% from here. And that would get us to 7,000 on the S&P 500 by the end of the year. That would be a 19% increase following double-digit increases the past 2 years. And I don't know if that's it. I've got 7,700 by the end of next year. So that's a 10% increase. And that's all consistent with the roaring 2020 scenario we've been talking about. We do in this quick takes, which came out on October 18th, came out over the weekend. It's our market call, Sunday market call quick takes. And so we did partially address the issue of the banking, the regional banks, the credit market issues. And we don't want to dismiss them. We're watching them. But we don't think this is going to be a real problem for the markets. The large banks certainly did not substantially increase their loan loss reserves. They're doing extremely well. Then again, we're watching the private credit ETFs. They suggested some stress. So somebody pointed out that this is the price. There's also like a 12% dividend on these things. So you're not getting completely crushed here. But this is obviously some signs of stress in the private credit market. And again, if things blow up in the private credit markets, I guess it could blow things up for the rest of the economy if it somehow shows up in the banks. But if it doesn't show up in the banks and these private credit companies are sitting on a pile of cash looking to buy things at 25 cents on the dollar, they'll have more things to buy at 25 cents on the dollar. And to the extent that some of them are losing money, the ones who thought they had $1 and now it's only 25 cents, that would be a cut in their rate of return on their portfolio and make people kind of regret that they got into private credit if they happen to be in that fund. Other funds could actually be doing quite well and see opportunities there. Meanwhile, we're not seeing much stress in the high yield market, the corporate investment grade market, the senior bank loan market, according to these ETFs. That's the nice thing about having all these ETFs. I mean, maybe they're going to all come back to bite us, especially the leverage ETFs, but now we can kind of get the market's assessment how various segments of the market are performing based on these ETFs, which slice and dice things rather neatly. Meanwhile, I've been watching the weekly data that comes out with the commercial loan release that the Fed puts out, and there's no signs that loan loss reserves are increasing. They increased them back here, I guess, when they thought there might be a recession. Remember when the office buildings all kind of blew up, and they really haven't been increasing them since. So that looks relatively common, relatively high relative to my thinking of the outlook for the economy. I think it's still resilient. I still think we're not going to have a recession, and I got the Fed put in my back pocket here. If once the government opens, and I think it'll be this week, and we suddenly get a surge of data that shows the labor market's weaker, the Fed will lower rates. Again, I think a lot of that's going to be productivity. I think a lot of that is going to hyperventilate the stock market, but it is what it is. The only skin I have in the game is trying to be on the right side of these things. I don't have any I try not to have any biases. I got criticized recently. Social media, I do post little tidbits of what we write, and somebody criticized me for being clearly biased against Trump, and then somebody else came back and said, Yardeni's not biased against Trump, he's just biased to being bullish. So I would agree with that response, and I don't often respond to these things. Anyways, earnings look great. Look at forward earnings. Forward earnings, all-time record high. They're converging over $300 a share, I think, by the end of the year to 2026. 2025 doesn't really matter anymore because now the market will be increasingly discounting 2026, and before you know it, we're going to have 2027 up here, and we're looking at $350 a share for 2027. We're looking at $450 a share by the end of the decade. Put a 22 multiple on it, and you get to 10,000 by the end of the decade. And oh, by the way, we've done some work on gold. Gold is a really good balancer. What's the word I'm looking for? It's really good at providing some offset to the volatility in the stock market. And they do tend to be inversely related, gold and stocks, on a cyclical basis. On a long-term basis, they tend to have the same trend. And so my analysis says that we could get to 10,000 on gold by the end of the decade. But that's all amateur technology, technical analysis. It's not doesn't come with a money-back guarantee, and isn't as fundamentally based on things like earnings and assessments of valuation multiples. But gold is let's look is doing quite well today, 149.50. I mean, what's going on here? I can't imagine it's just, oh my God, the ceasefire is breaking down in the Middle East. Who's really surprised by that? My hunch, it's well, a fellow called me up and who actually stores gold for investors, and he wanted to sort of partner with me in terms of marketing. And he says that Europeans are buying gold quite a bit because they're looking at the U.S. and they think we're about to go into a dictatorship and our economy is going to melt down and all those things. So that's funny from our perspective. That's kind of the way Europe looks right now. But I think a lot of this could be Chinese investors. They lost a lot of money in the property market. They've got whipsawed in their stock market, and they love things that go straight up. And so maybe they're the ones doing this. Indians also have long loved gold, and so again, this is kind of like Bitcoin. It's a global market. Who the heck knows how high it's going to go? It's like Bitcoin. Nobody really knows. There's no way to value the damn thing. Anyways, we update this chart now on a regular basis just to give you some reason for hope that there is fundamental support for the rebound in the Russell 2000. And you're getting a little bit of a indication here that both the small caps and the mid caps are showing signs of life. Meanwhile, the large caps just keep going up, up, and up. And it's not just the Magnificent Seven. You take out the Magnificent Seven, you still got a very good-looking profile for forward earnings for that. Let's see what else we want to talk about. I've run out of time because I want to have some Q&A. But take a look at the at the morning briefing. If you haven't yet, we say Halloween's coming, and here's some of the scary things that could happen. And of course, we tend to be optimists, and we tell you why we think they're not going to happen. So it looks like the 50-day moving average is going to hold. If it doesn't, there'll be a 10% correction to 6,000, but it looks like it's going to hold. Real GDP, the last real recession we had was back in 2010. This was the lockdown recession. So tell me the economy isn't amazingly resilient. The bull-bear ratio is a little bit on the frothy side, so it's probably going to get frothier. I wouldn't be surprised if we get to 4 or 5%, and maybe that'll be something that will be too many bulls out there that causes some sort of sell-off. But meanwhile, again, Ray Dalio is right. There are debt crises going on in Japan right now. There is one in United Kingdom, though. Again, rates have actually declined last week because of credit concerns, which made the sovereign debt look better. Same thing for France and Germany. So the world's not totally falling apart there. Here's that 4% level on the bond yield. Survey says, let's see what we got now. Just since we're having so much fun, 3.999. Okay, so we'll see which way it goes. My bet is it bounces off on a hotter than expected CPI. But on the other hand, looks like the Fed's just committed to lowering rates. Well, actually, it could be interesting, right? I mean, if they open up the government this week, some data may actually start to come out before the FOMC meets next week. But we'll see how that plays out. This is another fun chart with regards to the debt, the doom scenario for debt. And I pointed out that we did have a debt crisis back here in 2023, and Yellen came out with a bills policy that helped to bring rates right back down. Anyways, read the rest yourself. I don't want to shortchange you on the Q&A side. So let's do it. I'm sorry, Max. When my wife is home, Max and all the other dogs prefer to be with her in her office upstairs. So Max isn't here, but Max sends his regards. So here we go. Let's see if I can read this. Give me a second here. Make it a little bigger. The old gray mare, she ain't what she used to be. Okay, Willem. Schiller's cyclically adjusted PE is around 39. That is a bubble unless your scenario of 4% real GDP growth and possible even higher growth of profits materializes. Okay, so if I'm right, then we can live with 39. I tend to focus more on forward PEs, and forward PEs are around 22 for the S&P 500. My story there is that's not sustainable if the markets start to be concerned about a recession again, as was the case over the past couple of years. And in corrections, obviously that PE is not sustainable. But if the economy continues to be resilient and the market continues to come around to the view I've had that it's resilient and earnings are resilient and roaring 2020s productivity and all that, then the valuation multiple, even though it's elevated for sure, is sustainable until further notice. Willem also says, we have never seen growth rates like that for extended periods. 4%? I'll take 3 to 4%. I think we're already, past couple of quarters, we're over 3%. I'm not guaranteeing that it's going to be like that every quarter, but that may be starting to validate the roaring 2020s ID. Can AI and other advanced technological innovations really generate such a splurge in future profits? I remain in the bubble camp. Well, you say tomato, I say tomato, and so you're in the bubble camp, and I'm not. But Willem, I respect your views, and I certainly try to stay informed about all the bubble issues. But right now, I'm still in the camp saying well, the only thing we have to fear is too much fear about bubbles. The market tends to be sort of a contrarian, as do I. Lee. Akampura from Merrill Lynch was the only one signaling caution in the 90s. His nickname from the brokers was make him poorer. Yeah, and then he was right? Okay, thank you, Lee. I don't know that you're asking me for a comment, but thank you. You have now addressed this issue. I still remain in the bubble camp. Thank you, Willem. Chip, Dr. Ed, how would you weight equities to find the fixed income alternatives at this juncture for balanced portfolios? Well, depending on what your kind of normalized risk is 60/40 or 70/30, whatever it is. I guess relative to that, I would remain overweight stocks relative to bonds. Though right now bonds look like they do have the potential to get down to maybe, we looked at that chart before. I'm not denying we could get down to 3.6%. It's happened before, but I'm still of the opinion that 4.25 to 4.75% is the right range for the market. Let's see. I'm having troubles seeing this one. Let me see if I can raise it. Oh, here we go. That was Chip. JR. Hi, Ed. Any thoughts on crude oil here? Looks like it is potentially breaking down. Yeah, it looks like it's potentially breaking down, and nobody's really talking about it, but it's a huge stimulus to the consumer. It's a great source of disinflation, as is productivity. I mean, right now I think inflation's stuck at 3%, but once the tariff effect, and I'm talking about core, obviously, because with oil prices down, gasoline prices down, that's a disinflationary potential here. But I think the world's moving away from oil. From what I understand, the Chinese have just totally bought into electric vehicles, so that's not going to be a growth market for gasoline. I just brought a Camry, a Toyota Camry after I had a four-bagger. A pizza guy cut me off in June, and it was a nasty accident for my car and his car, but we survived it, and the pizza survived. And he actually, somebody came out to take delivery of the pizza, and he paid him. It was bizarre. Anyways, my car was totaled. I was looking around for cars. I don't really want to plug in. I don't want to wait for it, so I bought a Toyota Camry hybrid, and the tank only fills up with 9 gallons. So I think the more hybrids spread, the less the demand for gasoline and oil. Arthur, nice to have you join us, Arthur. What do you think the Fed will do with a hot CPI and Powell's most recent comment setting up rate cuts in October and December? Well, it looks like the Fed has kind of boxed itself in, Art, with this, kind of feeding the market's expectations for rate cuts. And if it's hotter than expected CPI, and they pursue with cutting the Fed funds rate, I think the bond yield will do what it did in 2023. So, and of course that would feed a melt up in the stock market. So we'll see. It's if it's hot enough. I mean, right now it looks like it's going to be 3% on a year-over-year basis. That's what the Cleveland Fed's now inflation measured is doing, and it's been pretty accurate for my perceptions. Okay, Lee, again, the more people think we're in a bubble, the less likely we're actually in one. A most bullish sign. That's my feeling, but on the other hand, I showed you the bull-bear ratio, and it may be that people are thinking in a bubble and are bullish about the upside prospects on a short-term basis. We're all going to be bubble players. We're all going to figure out how to stay in it until the very top. Finally, James, does it bother you that some of the big AI CEOs themselves say this is probably a bubble and welcome it as a way to get AI capex, even if investors lose? Yeah, it doesn't really bother me. I mean, I think it's just it's good that they're aware of it, because if there's an AI bubble, it's because of their spending, and so if they're going to watch it really carefully to avoid a bubble, that should be okay. So, anyhow, thanks all for joining me. Thanks to William for taking over on the call. I heard that there was. Okay, we lost connection there to our Tokyo branch, our Tokyo bureau, which William heads. William has done some really good work for us. I hired him after Eric went off. Some of you have asked me about Eric, and I'll give you a quick update on it if you have a minute. Uh, Eric was with me for a year. I taught him everything I know, and then I embedded him in the in the administration. And he on his card it says that he's a senior advisor to the chair of the Council of Economic Advisors. Well, after a few months, the chair decided to move over to the Federal Reserve as a governor, and Eric has moved over there as well. So Eric's got a spectacular resume. Uh, I hope he'll come back, but wherever he goes, we're still looking forward to maintaining really good contacts with him, and we do wish him well. And I guess anything is possible for Eric, given how spectacular his career has been so far for a young man. All the best to you, Eric, and all the best to all of you. Thank you.